All right, everybody, getting into another one. In this week's video, we're going to be going over Loblaw. Now, before you sit there, click away from the video thinking I'm going to be talking about a slow-growing blue-chip grocer here in Canada, I would like to show you a stock chart over the last 1, 3, and 5 years, just to highlight to you how well Loblaw has performed. When we look to one-year returns, we're talking 48% versus 32% from the S&P 500. We span that out to 3 years, and we're talking 92% versus 33% on the S&P 500. And when we span it out to 5 years, we're talking 173% versus 107% for the S&P 500. So over the last 1, 3, and 5 year timelines, this company has absolutely crushed it. It's been one of the best performing companies on the TSX index. And ultimately, these companies don't gather a lot of investments, particularly from investors who are consistently looking for the next best thing. They don't view a company like Loblaw as a company like that because it's a slower growing, low profit margin grocer. But there was an opportunity here during the COVID-19 pandemic, and this still is a Canadian foundational stock over at Stock Trades Premium. We added it to the list primarily because of grocery inflation, because of the, COVID-19 pandemic, the rise in food inflation, things like that. We thought we need to identify a grocer with the largest discount element in the country, the one with the widest reach, and the one that sells the cheapest products, because that is going to be the grocer that Canadians head to when interest rates go up, when food inflation gets high, when people start pinching pennies. And it's not like the COVID-19 pandemic where disposable capital was abundant. And as a result, this company has absolutely killed it over the last while. You're talking market-beating returns, and it is still posting some pretty strong results, but a lot of people are wondering if the value is still there. So in this week's video, I'm going to go over Loblaw. I'm going to go over their quarterly results, their KPIs. I'm going to speak on valuation, free cash flow, capital allocation, all that type of stuff. As always, everybody, if you want 3 free stock picks from our Stock Trades Premium platform, they are 3 of our foundational stocks over at Stock Trades, not including Loblaw. I will drop that in the description. You can get them absolutely free, no strings attached. But let's dive right into the video. So Loblaw reported its earnings a couple weeks ago. We're talking November 13th. It's the 25th as I'm filming this. And this quarter was actually I don't want to say weak, but it was one of the weaker quarters that Loblaw has reported in quite some time. And one of the main reasons for this is it's having some difficulties keeping up with the, what I believe is a permanent shift among Canadian consumers when it comes to grocery spending. So ultimately, there was a big surge in growth over 2022, 2023, and now they're having a bit of a slowdown in terms of same-store sales. And a lot of people are worried about this, but in reality, it's just the company just can't keep up with previous year comparables, and that's not necessarily a bad thing. When we look at revenue, $18.5 billion, it was up 1.5%. When we look to food retail, same-store sales increased by 0.5% compared to 4.5% last year. So this is what I'm talking about, that decline in same-store sales. So the one thing about this is Thanksgiving. Last year, Thanksgiving was in this quarter. This year, Thanksgiving was not in this quarter. So that had a 1.3% impact to same-store sales. So if we go kind of apples to apples, we'd probably be looking at 1.8% instead of 0.5%. But still, there's a notable slowdown there. And when we look to drug retail, they increased 2.9% compared to 4.6% last year. Now, it would be the same thing in terms of Thanksgiving, but I mean, pharmacy sales wouldn't really come in all that big in terms of Thanksgiving. I mean, I know Shoppers Drug Mart does sell some food items, but overall, there's a slowdown in same-store sales on a year-over-year basis. And I'm going to dive into the KPIs here in a bit, but I do want to go over the earnings. So we're looking at adjusted diluted net earnings per common share, $2.50, an increase of 24 cents or 10.6%. So a lot of people have questions as to how Loblaw is able to grow its revenue by 1.5%, and it does this fairly consistently, low single-digit growth, yet it's earnings per share have grown at a double-digit pace for quite some time now. And I'm going to get to that a little bit later on in the video, and I'm going to discuss how this company has been able to grow earnings this fast while revenue is not growing all that much, and it comes from very strategic buybacks and capital expenditures. This company is a very, very good capital allocator. It is very underrated in that regard. But let's focus on the KPIs. So the first thing I'm going to look for is the food retail same-store sales. So let's look at two very important times over the last 5 years. Let's look at March of 2020. We saw a massive, gigantic spike in Loblaw same-store sales. What happened in March of 2020? That was when the COVID-19 pandemic hit. That is when a lot of people got laid off from their jobs, whether it be temporarily, whatever the case may be. But Loblaw saw a massive surge in same-store sales. We're talking double-digit year-over-year same-store sales growth, which for a grocer the size of Loblaw's is absurd. So we fast forward to 2021, we hit the same situation where if we look from March of 2021 to March of 2020, it would have been very, very hard for Loblaw to keep up with that same-store sales growth because there was such a huge shift in 2020. Now, what happened moving forward through 2021? Well, the company had, as I mentioned, relatively tough comparables back in 2020, but they also had, capital money was, it was flush at this point in time. Interest rates were very low. People and small businesses were getting economic stimulus from the government, and as a result, we saw very little same-store sales growth until we hit June of 2022. And what happened in June of 2022, or around that, mid-2022 area? There was two things. First off, interest rates skyrocketed because of the inflation that we were seeing. And secondly, it would be that inflation element. Food inflation was going through the roof. And people who were, say, shopping at places like, I don't know, I can think of places in Alberta, Safeway, Sobeys, things like that. So these grocers, they're high-ticket grocery stores. They're not discount brands. Loblaw has a ton of discount grocery stores. We're talking No Frills, we're talking Superstore, things like that. So as a result, I do believe there was a permanent shift at this point in time to where investors headed out of stores like Sobeys and into stores like No Frills, Superstore, things like that. And this was notable in the results. You look at a company, if we look to a company like Empire, if we look to their results over this time period, they have really, really struggled. We're talking about, over the last 5 years, we're looking at 30% returns versus the TSX index of 75. When we go to 3-year returns, it's going to be even worse. We're talking 16% compared to, 29% on the TSX. And when we go to the last year, it's going to be even worse. We're talking 12%, while the indexes have returned much more than this, and Loblaw's has returned 4 times as much. There was a big shift in consumer spending here, and this is why we saw all this same-store sales growth from Loblaw. They had that more discount element. They have those cheaper items. You could argue all day whether they are lower quality or not, but ultimately, when times are tough, when people are pinching pennies, they're going to head to cheaper alternatives. So we fast forward to today, and we're seeing that same-store sales growth kind of flatline over the last, couple quarters. And again, we saw that in 2022 and 2021. It's very hard for Loblaw to keep up with this sort of growth because the shift in Canadian consumer spending, it's already done, and in my opinion, it's already permanent. We saw a bunch of Canadians shift to a company like Loblaw's to save money, and as interest rates continue to fall, as inflation continues to normalize, food prices are not going down. They're never going to go down. They might go down periodically over the short term, but if we get deflation, that is not necessarily a good thing. Food prices are here to stay, which is primarily why I think the shift in Loblaw's is permanent. I do believe this company is going to have continual tailwinds from people just looking to spend less on groceries and save more, and they do have that discount element built into the business and are rapidly expanding that. And the fact that they generate the most cash flow out of any of these grocers means they're going to be able to dump the most free cash flow into future expansion. So am I concerned about this slowing same-store sales growth? No. When we look to October 2023, 4.5% same-store sales growth, and then we look to October 2024, 0.5%, it's going to be very hard for them to keep up with numbers over and above this 4.5%. You know, the company has absorbed a large amount of new Canadian consumers, and ultimately I would expect their same-store sales growth to probably normalize with pre-pandemic numbers, which would be, you know, the 1 to 2% range. So next thing I want to quickly go over is the store counts. We can see the company has been, you know, increasing stores by a fairly reasonable pace. I mean, this company has a gigantic amount of stores here in Canada, so it's not going to be a company that's going to be able to, you know, grow stores at a double-digit pace. We look to October 2023, we're looking at 2,448 stores, where we look to 2024, 2,467. Building out grocery stores is fairly capital intensive, and ultimately Loblaws, every single Canadian on average is within 9 kilometers of a Loblaw store. So the reach of this company is already fairly extensive, but they're still going to continue to drive new store growth. And when we look to this article here from Global News, they are piloting ultra low discount no name grocery stores in Ontario. So effectively, these are going to be even more discount than, say, their No Frills brand, which is about as discounted as it gets. They're going to be piloting these in particular areas of Ontario because they believe that Canadians, again, that shift is absolutely permanent when it comes to consumers who are looking to save on cheaper groceries. I do feel this is going to be an added tailwind for Loblaw moving forward. Now, what is the result of these added tailwinds? We've seen a significant change in the free cash flow generation of the company. We're looking at, you know, pre-pandemic, they were generating anywhere from, you know, 1.9 to 2.2 billion in free cash flow. We're now sitting at cash flows in September of 2024 of $3.4 billion. Now, these cash flows have remained relatively steady throughout the COVID-19 pandemic. I mean, obviously, we saw that gigantic same-store sales growth back when the lockdown started in 2020. That ultimately caused free cash flows to pretty much double, nearly double. And then after that, they've been able to maintain that fairly steadily. The company reinvests virtually all of this free cash flow back into the business. If we go back to the quarterly report here, we can see that they repurchased for cancellation 2.65 million common shares at a cost of $450 million. Their free cash flow from the retail segment on the quarter was $562 million. Net capex of $429 million. And what they're trying to do with a lot of those capital expenditures, they're trying to improve the stores to effectively grow their margins. And as a result, I'm going to get now to that point where revenue is only growing 1.5%, but earnings are growing at a double-digit pace. This is primarily due to two things. First off, capital investments placed back into the business in order to make the stores more efficient, whether that be higher efficiency from refrigeration aspects of the business, whether that be from an employee standpoint, a labor standpoint, a product inventory standpoint. They're dumping money back into the business, and as a result, we're seeing a big increase in operating margins. So if we go all the way back to, let's say, September 2015, Loblaw had around 3.9% operating margins. That has not doubled, but it's gone up, more than 50% over the last while, and we can see a consistent uptick of operating margins since the COVID-19 pandemic started, and as a result, we're sitting at 6.59%. This is a 50% improvement from 2018, and when you have a company that generates this much revenue and relies pretty much solely on margin, these grocers rely on high volume, low margin sales, and they do that very effectively, and they generate a ton of free cash flow because of it. This expansion in operating margin is a result of capital expenditures being placed back in the business to make the stores more efficient. Plus, ultimately, that shift in the Canadian consumer is also resulting in them selling a lot more high margin products. So as a result, free cash flow has boosted, and ultimately another aspect of them being able to grow earnings per share so much is share buybacks. Now, this is a very, very interesting chart. When we look to their shares outstanding, at the end of 2015, they sat at 411 million. Now, if we fast forward to June of 2021, they sat at 338 million. So that's a total of around 73 million shares that they repurchased over this time period. Now, if we look to the company's share price, it stayed relatively flat. I mean, I would imagine they purchased the bulk of these shares in, if I were to average it out, it would be probably the mid $50 range. So even if we account for $55 a share, they spent about $4 billion on buybacks. Now, at an average cost of $55 a share. Now the company is $178 a share. So you're talking a significant benefit to buying back these shares at discounted prices. Those shares today, you're talking around, 73 million shares at $178 a share. That's $13 billion. So the company has been very aggressive in buying back shares recently, and it's worked out big. Even if we look to these late 2022 buybacks, the share price was hovering around $110, $120. So they've even made notable returns on that. And Loblaw is a very, very strong capital allocator. They have been for a very long time, which is why they maintain, near 20% returns on equity, 11% returns on invested capital. They have a very strong growing dividend. If we look to their dividend growth chart, it's pretty much, they've been making big chunky raises to the dividend over the last 6-7 years due to that strong cash flow generation. So the final thing I'm going to go over with Loblaw is valuation. Now the company looks on the surface very expensive right now. We're looking at a 5-year median average price to earnings of 20.83. They're currently trading at around pretty much 25x. When we look to 10-year averages, 25x. So we're talking about a high single-digit premium on a price-to-earnings basis, and when we look to a price-to-free cash flow basis, they're trading at 16.2x trailing 12-month cash flows. Their 5-year average is 11.49, and their 10-year average is 12.02. Just on the surface, it looks like the company is quite a bit overvalued. When we look to this price to free cash flow, it's trading at a 30% plus premium to its historical averages. But the main thing here is the market is likely pricing this company in the added tailwinds from the Canadian consumer, the fact that they have grown these operating margins so much, they're a higher margin business now, and ultimately the strong capital allocation. As I mentioned, we saw that buyback. Management clearly knows what they're doing. The wise spending of capital expenditures back into the business to boost those margins. Do I think the value gap is there from, say, when we first added it as a Canadian foundational stock? No. You're probably not going to get, the crazy amount of returns that Loblaw has provided over the last while. As mentioned, we're talking about what would the annualized return here be? We're talking about a 22% annualized return, whereas the S&P 500 has been about 15.7. You're probably not going to get that from Loblaw today, but do I still feel that there's room for the company to generally grow in line with its earnings, which have been growing at a double-digit pace due to those increased margins and those share buybacks, things like that? I would argue yes. I still do think this is a fairly strong company, and one that a lot of people ignore because nobody wants to own a boring grocery stock, right? But this stock it's absolutely killed it over the last while, and I do feel there's still added tailwinds moving forward from ultimately the company generating a ton of free cash flow that is going to allow it to continue to expand margins and also expand its discount presence in Canada. Potential forward food inflation that could, drive more Canadians to a discount type of business. And just overall, I do think it's a strong company that is, I would say, fairly valued at this time. So everybody, that's it for the video. Head down below, like the video, subscribe to the channel, comment down below, let me know what company you want me to look at. And as always, head down to the description. You can grab 3 free foundational stocks from Stock Trades Premium. It takes just a few seconds and you'll have full access to the research. And as always, everybody, stay tuned for more great investing content.